Having learned about assets, capital, and long-term liabilities in previous videos, let us turn our attention to short-term liabilities. In this short session, we will get acquainted with short-term liabilities in the form of creditors, bills payable, short-term borrowings, accrued liabilities, and short-term provisions. But first, what are short-term liabilities? Also known as current liabilities, these are debts or obligations of a borrower which needs to be settled within a year. For instance, if a business borrows a sum of money from a bank which is to be repaid or returned to the bank before 1 year, then this borrowing is a current liability. The most common form of short-term liability for most businesses is creditor or trade payable. During the usual course of the business, it is a common practice for enterprises to buy goods and avail services on credit. Money is repaid to supplier of goods and services within a short period, typically within 2-3 months, but not later than a year. Bills payable. The next form of current liabilities which can feature in accounting transaction is bills payable. Bills payable is a type of negotiable instrument. This is a legal document confirming the fact that one party or first party is obligated to pay money to the other party from whom the first party had received goods or services on credit. This document is freely transferable, and as I said earlier, this is also referred to as negotiable instrument. Let us understand bills payable or bills receivable with the help of an example. Suppose a retailer purchased goods on credit from a wholesaler. Since a written promise on a document that has legal validity to pay the money on a certain future date has more credibility, the wholesaler may prepare such a document. The document will contain an order to pay money to the retailer, and the retailer will put his acceptance of buying goods on credit and of payment of money on a later date with his signature and stamp. This document is called bills payable for the debtor or retailer in this case. This document binds the retailer to pay back the money for goods purchased on credit on a future date. This document, that is bills payable, is a short-term liability for the retailer. The same document is called bills receivable from the point of view of the wholesaler, which is a short-term or current asset. If the wholesaler purchases goods on credit from the producer of good, then the same bill receivable can be handed over to the wholesaler. Thus, bills receivable and bills payable are freely transferable and can be used in place of cash to settle transactions. The next current liability is short-term borrowings, which is pretty easy to understand. Short-term borrowings generally refers to raising short-term loans from banks whenever a need arises for business entities. The next short-term liability is accrued liability. At the first glance, this seems to be an expenses, but on a closer look, these are actually liabilities. The example provided here will clarify the matter. Suppose a business entity pays rupees 25,000 every month as rent for its office space on the 5th day of the next month. The rent for the month of December will be paid in the month of January next year. On 1st January, the rent for the month of December will be a liability for the business because the enterprise already enjoyed the accommodation but is yet to pay for it. Hence, this rent due or outstanding rent is regarded as a liability for the business as on 1st January next year. After the payment is done, say on 6th of January the payment is done, the liability extinguishes or no longer exists and it becomes an expense again. Short-term provisions. Oftentimes, business entities, out of its past experiences, can foresee and anticipate that at some later point of time during the year, a liability may arise, but it cannot determine the exact amount of that liability. In order to easily meet that future expense, it may create a fund so that future expense does not create a major burden at that point of time. To better understand the procedure, let us assume that during Christmas festivities, employees may have to be given some kind of gifts. The exact amount needed to buy gifts for employees may not be known at the earlier part of the year. So, the business enterprise may set aside some amount of money every month, starting from earlier part of the year. This process is called creation of provision. To summarize, provision is created when the liability or a future expense is known, but the exact amount of that liability is not yet known. The last topic of discussion is contingent liability. Contingent liability is not a liability at present, but may become one in future on the happening of certain event. For example, if a business is contesting a legal case in the court of law, then upon losing the case, the business may have to pay financial compensation to the other party. In that situation, a liability in the form of compensation may arise, but the outcome of the court case is not known at present. The business may well win the case. In that situation, the business will not have to pay any amount. Hence, contingent liability is not a liability in real sense. It may become one in future only on the happening of a certain event. Therefore, it is shown in the final accounting statements only in footnote, only as a footnote and not in the main part of such statements such as balance sheet. Thanks for watching. Please share this video.